Hi guys, welcome to the first video on or let's call this extended lessons. It's a fancy way to put it. We're gonna be going into um a more relaxed approach of how we trade, how we remove some of the things that um are cluttering our thought process, cluttering our trading process, and get some structure going on. So one of the first things I want to go over is kind of like an introduction and a little bonus at the end. So the trader blueprint, TCM guide to essentials of profitable trading, right? So trading is hard. So, like plain and simple, trading is hard. It's regarded by most traders who have been doing this for a long time as the hardest way to make easy money, simply because it's so hard to stick to the things that we know that are easy. Like in order to win the trade, you just need to click buy or click sell and then hold it and then close. But that alone is so easy that we make it hard. But we know it's not impossible because there are persons who have been doing it, persons who show you that they have been doing it. And if they can do it, we can do it. So it's very possible. The only thing that we have to ask is, am I willing to put in the work that it takes to get there? Am I willing to create the rules, plan, and mindset that is required to keep me on this path? I found that after reviewing some information, some surveys I got from a friend, he showed that the main reason that persons fail trading, depending on how long you've been trading and why persons quit, it's because you don't analyze yourself and you form fit yourself into statistics. For example, based on a survey, when you look at factors that contribute to traders' success, it comes down to the four basic ones that we all know and love: risk management, sticking to a trade plan, how you engage with the market, and trading psychology. It also shows you that based on how long you've been trading, which of these things are likely to impact your success the most. So in your first year of trading, if your risk management is crap, then you're not going to make it through the first year. You're going to blow the account. So risk management is the most important thing in your first year of trading. This already assumes that you understand technical analysis and you know what you're looking for when you go to the market. So you know what you're looking for, you see it, you go big, you win, you're happy, you go big, you lose a big chunk of the account. So risk management plays a huge part in the first year. In the second year, we have a balance between engagement, rules, and psychology, because the assumption is at this point in time, you'd have figured out that, hey, you can't size up on everything because it's going to crush you. And you have to be willing to stick to your trading plan, follow your rules, which may be order blocks, FVG, how you validate structure. So those are good. And now you're in the stage of understanding that, hey, I'm a New York trader because of my life. I'm a London trader. I'm an Asian trader based on my life. And you start sticking to those little things that creates the edge. So your engagement rules and your psychology is what keeps you through the first and the second year, or second to third year, really. Beyond that, you realize that rules of engagement starts trumping everything else. Risk management gets less important. Your trade plan gets less important. Psychology is still up there. But why does these get less important? Because you fully understand how you need to manage your money now. After 3 years, you know that if it's a crappy setup and you size up and you lose, that's a stupid loss. If it's a crappy setup and you cut the risk and you lose, okay, cool, you're fine. So your risk management is under control. Your trade plan is already solid. You know the market structure that you want to see, you know the session you're going to trade, you know the time of day. You know all of that. You have your rules, you have your backtest data, you have your forward test data. So you know all of that. So you're good. Even though you know your rules, life happens. You get to the chart late. You miss the morning session. You miss the move and you're stalking an additional entry. Those are the things in your third year that dictate your success. Are you willing to walk away if you miss the setup inside your ideal time? What if you trade 8 a.m. to 11 a.m. and something happened, you missed the ideal entry? Do you stalk a setup, a retracement setup after 11 o'clock? Do you just be done for the day? Those are the things that differentiate winning and losing when you get here. Once you get beyond year 5, it's everything. Your risk management is well defined. You know what account size you're trading, you know what account size you can afford to trade, you know what you can afford to risk. You're managing money, maybe somebody else's money. So you know that you have to commit to the rules that are stated in your contract. Your trade plan is very important because that's how you gather data and improve. If you're trading a plan and the plan is clearly showing that, hey, you're trading 8 to 11 and I don't know, 12 to 1, but all of your 12 to 1 trades are losing. And you analyze the data and you see that your 12 to 1 trades are losing, then okay, cool. You could fix that. If not, you don't analyze that, then you keep trading, not realizing that the data is clearly saying, hey, something is wrong here. So your trade plan is pretty straightforward. At that point, your psychology is not that big a deal simply because you're now confident that you know what you know. You know what an order block is. 5 years into trading, you shouldn't be wondering what's an order block, what's a FEG, what's the origin of the price swing, what's the range, is it efficient or not. You shouldn't be checking that at 5 years in. The only thing you should be checking is this information that's on the chart right now enough for me to push a button, or do I need to sit and wait? That's why rules of engagement is important. Rules of engagement clearly outlines that when you get to the chart, there's something you need to see. What is it? What is that thing that you need to see on your chart for you to get an idea or for you to frame a setup? See? Not what you need to see to push a button. Because if you need to see order blocks, you could see order blocks at any time. If you know that order blocks are what you want to see, when do you want to see it? This is the window of time I'm going to trade. This is what I want to see. So without going to a chart, you could say, okay, tomorrow I'm going to go trade. I want to see run on stops and then CSD after 8 o'clock, after 9:30, after 8:30, whatever it is. Why do you want to see that? Because if I see that, I'm likely to get this next because order flow is bullish, order flow is bearish, or whatever. It's that simple. If you don't see what you want to see and you still trade, then you can obviously move the markets. Because if you can't move the markets and you just see something random and like, oh, this candle is green, let me buy. Or you're a reversal trader, this candle is green, let me sell into it. And that's madness. There's no rules for that. And that's likely to have you fail. So when you put it all together, to be a successful trader, there are 5 main categories that helps you to grow, understand, and improve. And they are a thorough understanding of technical analysis, patience and discipline, risk management, using everything from 1 to 1-3 to build your model. And then once you're trading that model, review your performance. How many trades did you take this week? How many of them were winning trades? How many setups did you see? How many did you actually take? How many actually played out? Is there anything you could have improved? That's the type of thing. But again, over the next 5 weeks, we're going to dive into all of those. For this first video, I just want to make sure that the main things for how we look at the chart and the analysis is down pat. So yeah, let's jump into it. So technical analysis as defined by TCM. First thing that you need to know, clearly defined. There's no, I wonder what this is, or is this it? It shouldn't be there. It should be clear. Order flow. What is the order flow? Direction of HTF inflows, and it's primarily derived from a daily chart. Yeah, primarily a daily chart. Order flow is primarily derived from a daily chart. We don't make the rules, that's just how it is. What we do is create the rules for how to interact with order flow. These are my two main rules. If the order flow is bullish, then primarily I want to see price being delivered above the down candles highs and not their lows. Delivered and offered is two different things. Price can be offered below the low to pair orders and then delivered higher. But we'll get into all of that. Bearish order flow is the reverse. That's when you primarily want to see price being delivered below up candles lows and not their highs. It can be offered above the highs to pair orders, but then once those orders are paired, you want to see them, you want to see immediate reaction. And then liquidity. Any area in the market where orders are likely to come in based on the order flow is likely to be liquidity. So if I'm bullish, I'm looking at buying below lows. If I'm bearish, I'm looking at selling above highs. So I'm expecting liquidity to be above highs or below lows based on the order flow. Next thing we need to know, if a market is efficient or not. An imbalance or an inefficiency is classified as a range of price where there has only been one-sided delivery since the start of the price delivery. If the price started at the delivery started at 4 o'clock, what have we been doing since 4 o'clock? Only going down? Do we have an up candle body and a down candle body within the range that's created since the start of the range? If we don't have that, it's inefficient. If we have that, it's efficient. So an efficient range or efficiency is defined as whenever you see price being offered to both sides of the market, such that everywhere there's an up candle body, there's also a down candle body, classify that as an efficient price range. So let's say the delivery started last week, Wednesday. What have we been doing since Wednesday? 2 consecutive down candles. Okay, cool. Did we have an up candle body pass through Wednesday's opening price and close above it? Yes or no? Simple. Next, you want to understand order blocks. Order blocks are any range of price where price is delivered into a liquidity pool to allow for orders to be paired, thereby causing a close beyond the liquidity pool or a close into the liquidity pool. So if we have a buy side liquidity and price trades into it and price closes in that liquidity pool, that candle becomes an order block candidate, or in this case, a bearish order block candidate, since we're closing in buy side. The furthest price away from the order block candidate in its range, so an order block, open, high, low, close. If the candidate closes inside, the furthest price in the order block candidate is going to be the low. If we're violating that low, there's a change in the state of delivery, that candidate is validated, we could start trading when price comes back into its range, right? And graphically, you know what that looks like. Rejection blocks, if you have a liquidity pool and we trade into the liquidity pool, but we don't close, so we take the liquidity without closing liquidity, anticipate the lowest open or the last open or close in that liquidity pool to act as a rejection block. So price comes there and we should repel it. The open or the last open or close is now classified as the last area of order flow. It's the last place price was efficiently delivered because we have efficiency in bodies. If it's a liquidity pool, or let's say it's a low, the low of the range, we're gonna have a down candle and an up candle. So that's the last area of order flow at that low. If we trade through that low with a wick and it comes back, that wick just traded through the last area of order flow. The last area of order flow is still the bodies. We come back to the bodies, we expect price to just reject it, and vice versa. Okay. Now I'm going to show you some diagrams of these. Obviously, there are other technical structures, FEGs, all of that. The assumption is that you guys already understood those, so not going to reinvent the wheel. Just jump into some chart. This is what a bullish order flow looks like. By definition, price is taking up candles highs and not their lows. So you rarely see price coming back down below up candles lows, except right here. So this is a change in the state of delivery where opportunities are born. Bullish order flow, change in the state of delivery, you're buying below lows. We have FEG and lows and order block, perfect. Propulsion block settings, and it runs higher. Bearish order flow, in the reverse, we have price trading through up candles lows, but not their highs. Right here, you'd have change in the state of delivery where opportunities are born. So when price is taking that up candles high right here, you're looking for something above the high inside the range that could facilitate short entries to go lower since the order flow is bearish. Liquidity, basic definition of liquidity. This is a failure seeing liquidity pool, as well as liquidity pools created by short-term changes in state of delivery. Let's get back here. So we have this candle took this candle as high. This is a stop run. Stop run don't house liquidity. This is a failure swing because it fails to get back above here. Liquidity is resting there. So once you get that change, look for a run higher. Relative equal lows, that's liquidity. Changing the state of delivery because we're trading below a down candles low. Once you get a CSD again, after the races, is a liquidity pool, you're looking for an expansion. Once we take that, you know that when this high gets taken here, this is the start of a new delivery. This delivery is a market condition called retracement. But this retracement is a retrade because the range is efficient. South side, buy side, fair value, 50%, push. This leaves the range. We know this is the start of the new delivery. All that good stuff. Feel free to pause the video if you're watching to validate, check. Imbalance versus efficiency. So let's start here. This is the start of the delivery. All of these relatively equal highs here. That's the objective. When we took this high, it wasn't with a wick, it was with a close. So the next candle starts the delivery. Sell side delivery, that creates the range. That range is all down delivery, so that's your imbalance. When price comes back up and closes above here, that's when the range is efficient. So all of this range is now efficient. Retracing inside an efficiently traded range, retrade. Support ideas, higher prices. Range high gets taken with a close, not a wick. New delivery starts here. Initial imbalance, this is all buy side. We come down here, it's efficient right here. This is the candle that closes below all of this and makes the range efficient. This is price passing through an efficiently traded range, so retrade. This is not an imbalance because the range that we're passing through is already efficient. And there we go. Beautiful stuff. Same thing happening over and over again here. This is an example of a range we open buy side, trade lower. This was not efficient, but we left. So we left the range inefficient. Price is gonna come back, and we're looking for a down candle to fill in right here. Didn't come back until here. That ends the delivery. Short-term change in the state of delivery. Then we continue our regular scheduled program. Bearish order blocks. Buy side liquidity. We trade up and close in liquidity. Order block candidate. Furthest price away is the low. We take the low. It's validated. Short-term change in the state of delivery. So this is a bearish order block. Short-term change in the state of delivery is bullish. Takes down candles high. Look for entries inside here. Target where the liquidity is resting. Same thing here. Sell side liquidity. Right here. This is the candle that closes, creating the order block. This traded through the liquidity, making this a rejection block. Watch how we trade around that. Price not sure what to do, waiting for something. We want a short-term change in the state of delivery inside the order block. So this is the order block. OLR, or the short-term change in the state of delivery, taking that low. Best entries are going to form below here, then we push. Now, this only happens in this scenario, and this is what I mean. When we take this down candles high, this is validated. I'm expecting a retracement and then higher. This retracement and then higher does not make new highs. So watch this up candle low. Same thing if you're bearish. So you're bearish, this validates it. I'm expecting price to retrace and then new lows. The retracement here comes all the way inside the order block, above the down candle high. Anywhere inside here should be fair value for selling and beautiful run lower. Rejection block, sell side liquidity pool, wicks below it, no close, no bullish order blocks are right here, just rejection blocks and changes in the state of delivery. Price comes back down, it closes below it, right here. No, it didn't close below. Still rejecting the rejection block here. CSD again, same idea. Then it's off. Okay. Now for your own self-study, I just have 3 things I want you guys to pay attention to identifying on a chart. Just get used to seeing where they are. Forget about marking highs and lows, and instead mark where the swing started, where the delivery started, and where there was an engineered origin. Focus on these. You should be able to read the price action a little bit better. So quite a lot for the first video or the first week, just to get the ball rolling. See you again next week Sunday when we put out the next video. Yeah, do enjoy the rest of your week and see you.